So, hello.
Hello. Good afternoon, everyone. Hope you had a refreshing tea break. Good afternoon, guys. Yes. We now invite our respected speaker for the session, CA Harshal Bhutta, sir, Vikasa Chairman, CA Jitendra Saglani, sir, on the dais. I would like to call upon our Vikasa Chairman, CA Jitendra Saglani, sir, to address our audience.
So it's not an address, it's just an interaction. Friends, thank you so much that you were waiting. He got a little occupied in the interim. He had something to attend, his personal, say, घर का काम चल रहा है ना सर के. So he was actually there, but he still made it possible today. And friends, tomorrow we'll be having interesting sessions back to back. We are also trying that Bhavar sir would be here. So in case you have friends who are like writing the exams and they have the exams in the month of September, you can just ask them to come down for his session, that they get something which is a value add for their exams as well. So and I thank Harshal sir for making it possible. Me and Harshal sir were actually say in touch since 2022. I was the chairman at Nagpur branch, and that was a time when the first session of his we had a virtual one. So amazing experience, and this time again we have him, and today he will be speaking, say giving an overview of what is international taxation and the provisions and all that. So looking forward to an interactive and very interesting session, sir, and thank you so much for gracing.
Take the session forward. But we forgot something. Our introductions.
Begin.
So I'm Kritika Jain.
And I am Dhairya M. Thakkar. And today we would be deep diving and understanding from scratch to scrap how exactly international taxation works. International taxation has surely been a mystery for many of us, but no more. Now imagine you have $1 million transaction, your client would need help, and for that assistance, you have been chosen to cater. Now stop imagining because we are at the right place. Today, by the end of this final session of day one, we would surely be deep diving and going through a journey where we will understand that cross-border taxation transactions aren't that taxing. So why to waste time? So without ado, I would like to call upon Ajinkya Dalvi to introduce our esteemed speaker.
My dear fellow learners, fasten your intellectual seatbelts because now we have with us a personality who makes international taxation sounds less like a rocket science and more like a masterclass strategy. Yes, we have CA Harshal Bhutta sir, who is a chartered accountant, MCOM graduate, advanced diploma holder in international taxation UK, and LLM in international tax law from Vienna. In short, if degrees were airline miles, he would be flying business class for life. He is currently working with PR Bhutta and Company Chartered Accountants. Also, he has over 17 years of professional experience and specialized into international taxation, transfer pricing, Indian foreign exchange regulations, and business valuations. Also, he has delivered over 100 plus lectures across ICAI, ICSI, BCAS, CTC, Tax Sutra, Taxmen, and leading corporates, including India's only 30-hour FEMA Masterclass series as a solo trainer. Clearly, when it comes to tax, finance, or FEMA, his voice isn't just heard, it's trusted. So please join me in giving a warm round of applause to the man who makes cross-border taxation less taxing and more fascinating. Handing over to the MOCs.
I would like to call CA Jitendra Saglani, sir, to felicitate our speaker. Friends, please join me in welcoming CA Harshal Bhutta, sir, for his session on international tax, an introduction and journey ahead. Sir, the stage is yours.
Very good evening to all of you. Apologies for the slight delay. Thank you, Jitendra ji, for the humbling words. And I really love the enthusiasm here. But $1 million transactions, so हमारे पास भी इतने नहीं आते हैं. I hope I am able to, explain a lot of the basics to you today. And please, if there are any questions, just one moment. I'm trying to adjust. Yeah, this is better. Please do throw your questions at me. I'll be more than happy to answer them. So, my focus today is overview and the background of international tax and where the road leads ahead for all of us. Lot of interesting things happening in international tax. As always, it's an ever evolving field. Not that in new 2025 that has come a lot of changes, at least from it. Basic core concepts still remain the same, and a lot of concepts are evolving as on the BEPS, the MLI, which I have covered here. A lot of case laws are coming up. Supreme Court in the recent Hayat's case, it has unsettled the concept of P for all of us. Whatever you are understood, from permanent establishment, you read the Supreme Court's decision, and you will be perplexed that acha, also a kind of thinking that one can do. Not very well accepted internationally, but they will have to adjust to this. It's a reasoned order, nothing like that. We quite tribunal order, I think, in the last week again gave which threw up a very interesting interpretation stating that even for MLI, for whatever changes that are to be made in each of the treaty, you need a separate notification. India has already had a notification issued in 2019, but the decision is very, very surprising, saying that no, that common notification changes in each and every treaty. Each treaty wise, you separate notification relying on the Supreme Court Nestle decision. Again, Nestle was a little bit surprising. So all I'm trying to evolving field, nobody is a master in that, neither me, neither anybody else. Supreme Court, Honorable Supreme Court is not infallible. Lot of times, the judgments are debated, very hotly debated internationally. In India, you may have a difference of opinion. There are so many international authors. The Supreme Court itself refers to a lot of commentaries, clause vogel commentaries. You can see all these celebrated authors in the Supreme Court decisions also, Formula One decision, etc. Again, joining the thread, Formula One decision was also one which was very hotly debated. That also tried to introduce a new angle to the permanent establishment concept. With that, take you what is the concept census. Okay, so before that, let me explain the presentation outline to you. So what I'm trying to do today is at least give you a good background of the treaty. Okay, under domestic tax, now I'm not going to domestic tax. Under the domestic tax, there, sorry, 91675 for D will be there. 92 transfer pricing. Honestly, I actually had some slides on that, but I removed because time is not sufficient for that. But focus will be the treaty. So laying the logic behind that, then how to read a treaty. If you want to go ahead and read a treaty, examine a case for any of your client, or studying further, where do you go, where do you look at, etc. And then certain latest development. BEPS is also not latest, MLI is also not. It's been, you would also have been hearing. Pillar 1, Pillar 2 is something that is hot. Pillar 2, India, even in the new Income Tax Act 2025, with any provision. Pillar 1 internationally also is still in the making. A lot of flip flops now with the Trump administration. Again, Pillar 1, in what shape it will come, nobody knows. Uh, Even the fate of Pillar 2 over time. So if Trump continues for another term, I'm not really sure what would be the effectiveness of Pillar 2, because US effectively is stating that we have guilty provisions. We will not respect the Pillar 2 provisions at all. So interesting. Again, let's start core basics that are there. So yeah, roughly I have all the concepts that can beyond the presentation anyway will be shared with you. And now with CAGPT also, you yourself can find out a lot of concepts yourself. Session aim is that it should stay with you. When you study this in detail, it's always going to be an addition to the base. So I'll try my best to base for you. Resident reality. There also they have referred to this concept of source and nexus. So in simpler terms, whenever there is a cross-border transaction, very simple example here. Mr. A, tax resident of India, deriving interest from US. Tax residents of India, meaning India becomes the resident state. US becomes the sole prices in the A who's on USA. Residents the worldwide income. Okay. Because the nexus is so strong that you would want worldwide income of that individual, or it may be an entity, company, partnership firm, in whatever form that person may be. Source state, meaning if you have made investment in USA, what is your connect USA? Only the investment. So therefore, logically, US would tax only the prices from the could be in the form of dividend, interest, or even capital gains. There, that strong says that US can tax you on your worldwide income. US becomes a source state. India is a resident state. Interest will for withholding tax percent under the withholding tax. Fancy word for TDS, nothing else. Always, in international tax language, you will, see the terms withholding tax and a lot of other jargons that are there. Try to break them down. Withholding tax is a fancy one term for TDS. Whatever withholding tax will be suffered in the US, you will get a credit of that against the tax that you will have to pay in India. They will tax the worldwide income, including the US source income, but you will get a credit of that against this. So this is the core concept of residence and state. Typically, in a cross-border situation, it is two states. Okay, in majority of situations. In very, very complex, there could be three states also. Then it becomes a triangular situation. Okay, triangular situation is something that is very, very complex. In India, at least I have not come across any High Court or Supreme Court decision dealing with that concept. I will not like to take that up at least today. What kinds of taxation? Juridical double taxation. In treaties, typically it deals with juridical double taxation. What do you mean by juridical double taxation? One person is taxed twice. It's in US example, Mr. A is taxed in US also, Mr. A is taxed in India also. It's juridical double taxation. Okay. What is economic double taxation? Economic double taxation is same income is suffering tax twice. Same person, economic is on the same income. Okay. So economic double taxation, two simple examples in transfer pricing. Between the related parties, a transaction is being carried on. If there is an adjustment that is happening, so let's take the same two states, India and US. Two entities are transacting. Adjustment that same time US also does not give a corresponding credit for that adjustment. Then it is two persons same income. Let's say India is paying royalties to the parent in US. The Indian tax authority makes an adjustment, upward adjustment to royalty. Say, once year adjustment that is being done. US does not accept that. It says, no. From our side, it is maybe from Indian side, expenditure may not be at arm's length. Let the Indian tax authority increase the income. We are not going by way of a increased deduction at our side. Okay. Sorry, reduction in the income. Here it is increase in expenditure. There the income remains same, so therefore there is double taxation. Another example, double taxation plus dividend. Whenever a company pays corporate tax, less dividends, the shareholders are again taxed on that income. Income remains profits of company twice. Many countries you will see this participate. Again, fancy word, but I'll break it down for you. Participation exemption meaning that you are participating in the shareholding of that entity. Therefore, as a shareholder, it is your income itself. It pays income tax on that. It will again not be taxed. So it may qualify as a dividend. So that relieves the double taxation. Double taxation can be relieved under Article 9 with transfer, wherein India has now agreed, wherein this provision, if it's there, of corresponding states contracting state side, then the other side, there is no economic double taxation. Juridical double taxation, very simple example, Indian company paying commission to UK company, obviously there will be TDS in this example, not necessarily because now you already have many high court decisions. SLP dismissed against them in the Supreme Court also, virtually settled that for services they may not be taxable in India, but for India there is no TDS. There is TDS on that income in India. UK company will get taxed in UK also. So here, which is a source state, which is the resident state. Source state is India for the UK company, resident state is UK. Okay. So this is juridical double taxation. Same income getting taxed in India by way of TDS, same income getting taxed in UK by way of residence-based taxation. That will be relieved obviously by way of tax credit. But at the first double taxation happens, be relieved under the DT or under the domestic tax law also. Just like in India, we have section 90 as well as 91. 91, there is no treaty, so you will get a unilateral under the domestic tax law, which is the Income Tax Act. Wherever there's a the other country, provisions, the DT also comes through section 90 only. Economic double taxation, this is an example of transfer pricing. ALP of commission is determined at 9. For what has happened? 10 expenditure, I mean, that's a company will pay tax on that. No, double taxation. So not the UK company, India company. India company's expenditure from that has come to pay tax on that, whereas UK only they will not reduce it from 100 to 90. So therefore, there's a double taxation. Economic. Why economic? Because 10 rupees is being taxed at UK at the UK. More simpler for you all to understand. Why do you need a DTA? If in the world there is, why will anyone invest into another country? Another meaning, why will a person from developed nation invest into a developing nation? So therefore, developing nations typically give SOPs. What are those SOPs? They enter into double taxation treaties under the dividend interest royalty FTS article. There is a reduced withholding tax will be benefited from. Let's say it is in same example, India, US. This is a reverse situation. Developing nation person is investing into US. US under domestic tax law has 30% withholding tax rate. I can't recollect under India, US, what is the reduced withholding tax rate, but let's assume it is 20%. US would have taxed at 30%. India is going to tax. You are in a 20 average. You are not, because you are worse off. Entered into US will deduct tax at, you are paying in India, you get credit of only 20%. India, you would have been taxed at 20%. Now because you are investing in US, 20%. So therefore, investing in India versus investing in US. That is what the treaty does. So in order to entice investments into a country, that country is with various bilateral countries where they can investment flow. All of us know all the economic the percentages dip. Always a worry that how will the next cycle of, where will the next, obviously increases its deficit, and at the same time does a lot of developing countries. They will do is tell them that no investment into a, don't suffer the treaty. Say there is a Canadian government fund. You will obviously see what they invest, they will not be taxed. So therefore, their returns are absolute. In India, it will be post-tax returns. So therefore, they will negotiate with the other government, reduce that. That's why given India Mauritius treaty in the early days, India Singapore treaty, we didn't have those kind of investment. Let's say this to India, Canada DTA. Capital gains is not exempt. Therefore, they came through Mauritius. So that they are not working. Mauritius does not tax. Canada does not tax. If India started the foreign investment, you will get foreign technology. Tax rate 20%. The real cost for US because it is foregoing that revenue costs. Negotiation that takes place. Why do you think negotiated? Today, India UAE DTA news, the kind of flowing into Indian mutual funds versus equity. Why? Because under Article India UAE DTA, case for mutual fund is not does not have the right. Right, it's an immediate tax to you. It's again risk of shopping, just like I told you. Canadian pension fund coming through Mauritius, you are doing treaty shopping is favorable to you. Okay. Then the risk of double non-taxation, not being taxed. UAE capital gains on mutual fund. UAE does not tax investments, even under the new corporate tax law that has come. Try to tax under treaty. So risk the things that are there. Okay. What are the stages in the life? They will also have place. Initialing is there. Why is initialing and signature different? Initialing is basically signifying or conveying that yes, these are the terms of our understanding. It is between the negotiators. Negotiators do not have the power to enter into a DTA. In India, at least that power is with Parliament, which has done delegated that to CBDT by way of notifications. So therefore, after initialing, there is signature, then that needs to get ratified by CBDT by way of notification. After Nestle decision, it's a no-brainer. Changed to that negotiated initial sign changes to the treaty by way of protocol are as good as possible. Then entry into force. Why is there entry into force? Because the notification will state that, this protocol that we have entered into will come into force and so date. So it is typically, after later of the dates of ratification by either country to force, because you don't know how much time the other country's domestic tax law procedure is going to take. From India side, it is simply CBDT issuing a notification. Khatam. Other side, you don't know. Like in Australia, you have to pass an act for each and every treaty for it to enter into later of the notifications. Typically, from so many days from later notification, typically the treaty will enter into force. Entry into effect, that is the effective date. Effective date, you have to choose a date, right? Date meaning from which date this will start. Typically, it is clear. You will also see many times, between two countries. US, Singapore both have calendar year. So therefore, whenever any changes that may take place, they will say, US will say, no, no, this treaty will come into effect from 1st January. We will say, no, our financial year is 1st April. So that is the entry into effect. Then this is 1990. The difference between countries is not with countries but with the territories. Something like Taiwan. We have with Taiwan. We officially country because of political compulsion. Even recently, the newsprint all across started saying, no, no, India has accepted the one China policy. Taiwan is part of China. Accepted Taiwan. Then India Taiwan treaty will apply. Taipei or India China treaty will apply. Same under FEMA, people started saying, so then press note 3 will apply or not? Government permission for FDI. So these statements can't be taken lightly anyway. It was officially not negated, but I think the press release of MOF Foreign Ministry was very clear. We have not stated that we have accepted relations with Taiwan like any other country also has. Clear? Difference 19 is important. Next two slides. In fact, all slides are important, but this is basic concept. Comprehensive DTA was a limited DTA. Limited DTA, the most prominent examples are the tax agreements. EIES, double taxation there. So therefore, it is only for information. So there are limited agreements. We also have with some, other nation. Only. The airlines. Almost all the countries which are there, who's a resident, business profits, where will they be taxed, interest, royalty. Bilateral is two. We have a multilateral provisions are there. Students, teachers, dividend interest, royalty, capital gains, business profits. No. The bilateral to control electoral convention. Also one of the class. To make changes to their own treaties will deposit a ratification instrument with OECD. That's how taxation will happen. Then model tax Indian model and US model. US also, you are typically concerned with US treaty only. Beyond that, nobody looks at US model. Then you are left between OECD and UN. You see so many of our court decisions, they will also refer to these models. Engineering analysis, Supreme Court decision, extensively refer to the OECD model. Article 12. What do you mean by royalty? What about copyright, etc. OECD model is the start both of the treaties. UN model. So UN model, most of the provisions, 90% of the provisions will be the same. 90% of the commentary will also be the same, picked up from OECD, and then there will be maybe digressions wherever. So, station is refer to OECD model, and you will kind of deviations, observations that countries can place. That is basically by OECD nations. Non-OECD nations can also comment. OECD, there's a lot of positions that we do not agree with this pact. Really amazing. If you go ahead, look up yourself. Deviations. Obviously, every country cannot have the same domestic tax basis. Very simple example is pass-through status. LLPs in UK have pass-through status. LLP is taxed to a exempt partnership. UK, it is to be taxed. So therefore, when it comes to the treaty, there may be different variations. India may say no. We will not let the partnership, the treaty benefits flow to the partners. We will treat the corporate body. UK will say no. As long as the partners are okay, I will give you the treaty benefits. Variations can be there, is what I am trying to convey. Okay. The Indian tax authorities always try to rely on the UN model because they say that we have a bigger voice in the UN. So therefore, whatever provisions that are there closer to what is there at home. Let's take for an example the royalty article. If you see the OECD model tax convention, then that royalty income can be taxed on the source date. Royalty says no, so this is a market jurisdiction. You are earning royalty because you are doing business in India. So if I have the right to tax, what is it? Favors the developed countries. UN model is more balanced. US माई बाप है, उनको तो जो करना है वही करेंगे. So therefore, will have provisions which favors itself. Yeah, latest OECD model is 2017. Then step by step additions, deletions keep taking place. That is updation to the commentary. UN is 2021. UN now has a model on fees services also. We have had this the UN source taxation coming into international arena. It has always been favoring the developed nations. Small tax convention, US is typically 2016. What about to 2017? told you, the Supreme Court has also said that if a particular provision is being modeled on the OECD Model Tax Convention, provision meaning the article of the DTA, you can refer to the OECD model commentary also. Apart from that, bachao, the domestic tax interpretation of the treaty cannot be done, because whenever you are negotiating, it is always a give and take. Just like, there were rumors when India Mauritius was negotiated. Mauritius may have promised India army base. Mauritius. That is the reason that we also agreed to give them capital gains tax exemption. All this is not there in black and white, but the point that I am coming to or making is that it's always a bargain to give you this flows. So if there are a lot of FDI, obviously those countries will tell you, no, whatever income streams are there on FDI, give me as much benefit as you. Versus India. Now, is providing US. So we will also tell them, then give us benefit, service income, that IT services since past 2 decades. Go with your strengths, flows, inflow data. If you give maybe a 5% benefit under the treaty, how much tax revenue loss is it going to take place? You see, after every budget speech, the finance minister says revenue loss of many crores. Obviously, everyone does their math. How will UN US? For US treaty, US technical explanation is the best. Well, on the UN model tax convention, UN model convention, you go to UN commentary, and OECD is always going to be there as the base. When it comes to principles, the model commentaries are there to understand the provisions, but when it comes to principles of interpretation, it is a Vienna Convention. We entered into good faith, etc. Well, CLT, that is, protocols also give the associate multilateral. So now, since because of multilateral instrument, whatever changes are there, there are certain. So there is a multilateral instrument informal commentary also. So you can refer to that also. Why we are making changes to this article, etc. Judicial decisions on either side. Then there's always a tug of war. Whose court decision you respect? Will it be the source country's tax court decision, or maybe even Supreme Court decision, or it will be the residence country's decision? So in Nestle, this was very hotly debated. The source of interpretation. Now, other countries' tax authority, just like notification circular. Circular is basically explaining the provisions of a particular clause. Other countries, because of notification, stating that for you get the benefit of most favored nation clause, irrespective of whether Indian government has issued notification, etc. Not. It didn't mention only. It didn't consult the Indian tax authority. Now there's a Supreme Court decision. So now what to do? If that other country is taxpayer of the to India, I will say no, because he has not for this treaty. So then if it is correct, you do agreement procedure. Because if two countries' tax authorities are taking varying positions to interpretation in their bilateral treaty, then they have to come to, that is at least the expectation. So in most cases, MAPs are entered into in particular cases. In very few cases, maybe if both countries cannot come to a common ground, then it result to double taxation. Structure of the treaty. This is the most important the presentation. Is structured. Provisions. Just like in income tax law, we have these scope provisions. Scope of total income, section 5. But to any other provisions later on, similarly, these are the basic provisions or articles to access a person. The tax mean mentioned which taxes in the treaty. GST is not double taxation treaty. So therefore, Article 2 will not be satisfied. So you can't go to the GST and any other kind of taxes that are there. So person, see whether taxes are covered and see if you are a resident. Only if you are a resident, you can access that treaty. A resident Indian, you can't access US treaty. You can access any treaties. Therefore, these three are very, very basic. So you have to see if you are eligible to take the treaty benefits or not. Then come the definition provisions. Lot of definitions are given. Defined. The seashell. Then permanent establishment, which is one of the most posted only if you have a permanent establishment. The golden rule is a very big role. Okay, and you will see all these decisions, the higher decision, the Formula One decision that was there, all those were on permanent establishment. After the definition provisions, do I have a pointer here? So is there a pointer? Pointer. Laser. Anyway, by then, so if you are able to satisfy the scope provisions, you have understood that your income falls under, you are able to satisfy the definitions, then you go to the substantive provision 22 will provide or because Bluetooth is there. Done. It's fine. Okay, it's fine. It's fine. So articles allocate tax states, the resident state versus the source state. Just like as I told you, India UADT Article 13(5), India does not have the right to tax capital gains on mutual funds. That comes under Article 13, which is capital gains. Under that, you see the category asset class which is there. The residual. Residual, India has not been allocated the right to tax. only UAE has been allocated the right to tax that. Okay. So there are these example DTA as a reference. I will explain which article gives taxing rights to which state. So substantive provisions are the major ones which you will see day-to-day practice. Okay. Then there is anti-avoidance provisions associated enterprise. Typically, the AE article is relevant basically for corresponding adjustment only. Otherwise, the article 9 only. When related parties will become associated enterprise, etc. So here under important provision. But for miscellaneous provisions. Okay. So these are provisions which do not come in the flow of the treaty, meaning in the structure. Because first you have to see scope, then you have to see definition, then you have to see substantive. Okay. If both countries have the right to tax, let's say I give the example of India, US interest. US can tax 20%, India's elimination of double taxation has to take place. So therefore you come to Article 23. So if Article 11 states, then you come to 13. So therefore these set of articles, but they are miscellaneous provisions. Non-discrimination is the article which tells the sole state that you can't discriminate against my national. MAP is mutual agreement procedure. When I told you two tax authorities take differing interpretations to a tax treaty. UI is exchange of information. Article 26, very, very important in today's times. Collection of taxes, assistance in collection of taxes. So let's say, if a Indian resident is absconding and they have earned income in the UK and not paid tax in the UK and come back to India. How is the UK HMRC going to catch them? They don't have any address there. They don't have any place of residence, etc. Nothing. So therefore, they will take the benefit of Article 27, send a notice to that person through CBDT. That is assistance in collection of taxes. Article 28, diplomats. Diplomats typically they are doing foreign function, so therefore they will not be taxed in the source state. 29 is limitation of benefit. Limitation of benefit is in order to curb treaty shopping. So therefore certain provisions will be there where the treaty benefits will be restricted. Have done is provisions. So in the flow, what do you first have to do? First you have to how the income is foreign person. So a non-resident person, that may be individual, company, partnership, etc. investing in India. Let's say they are earning capital gains income. You will first see whether it does not tax them. The example of resident individuals, section 1042, NRE interest is exempt in India. Question of there is no double taxation, it's only single taxation in the resident state. So therefore, for each stream, you first have to see how is it taxed in India under the Income Tax Act and see under which article does that income fit and then see whether India has got the source taxing rights to tax. Again, coming for the mutual fund, against the mutual fund, UAE NRI investing in Indian mutual fund. India is going to tax it under section 111 to A. There is no exemption on mutual fund taxation. So there is source taxation in India. Then what will that person do? That person will say, now let me see whether India UAE DTA gives me any relief or not. Then they will go to the treaty. Then they will see, acha, capital gain. So you go to Article 13. Is it equity shares? Is it business asset of permanent establishment? Is it movable asset income, immovable asset income? Then last is residuary, mutual fund. Acha, mutual fund, India does not got the right to tax. Okay. That is how double taxation is avoided. So these two are also different concepts. Avoidance of double taxation, relief from double taxation. Relief is typically the elimination of get credit for the tax that you have paid. Avoidance meaning it's avoided place. Treaty. First see whether the income is taxable in India, and then you see whether there is any relief. That was a situation. Now what about outbound situation? You are investing in US, interest income you are earning. So you have to first see whether US is tax. Again, coming to the example of capital gains. You and me investing in US stocks, US does not tax capital gains. It does not tax capital gains, then where is the question of double taxation? It's only the resident state who's going to. So there is no question of even seeing the US DTA. Double taxation, that is when you see the DTA, and that is when first you see Article 1 to 4. Are you a person? Article 1, yes. Is it income tax? Article 2, yes. Are you a resident of either of the state? You are a resident of India investing into US. You are a resident of India, yes. Therefore, you can access the treaty. But then see substantive provisions. What does the article on capital gain say? If you see the DTA directly, India US DTA says each state will tax laws, but it does not give you any guidance. So first you have to see domestic tax law. US domestic tax law, does it tax capital gains? If it does, then you go to the treaty to either it relieve or it can avoid any double taxation. Okay. So this is the sequence. The Indian income tax is a treaty which are provisions. So if a non-resident is earning income from India, first charge of tax depends on again section 5, section 6, resident, something like scope provisions. So there has to be a charge of tax on the income. The scope of for a non-resident, which types of income are taxable in India? Only the source, Indian source income is taxable in India. Then, oh, it says, I think while converting to PDF, this has not come out properly. Anyway, I can explain this. So scope, it applies to persons. You have to be a person. Then transparent to you. UK, LLP is treated as a pass-through. LLP is not taxed, the partners. LLP is treated as a corporate body and that is taxed. So in under Article 1, typically this transparent entities rule will be there, which says that if you or your constituent is taxed, they will get the benefit. Article 2, again, what kind of taxes are there? So it may be salary taxes, it may be property taxes. So in UK, you know, inheritance tax is different, capital gains tax is different. Income tax act is cover under the TT. That obviously negotiation. Finland side, they want to cover church tax also. That's a kind of tax they want to cover. So say tomorrow, if two countries say that no, we want to cover even in two can fight, and they can say no, I want to cover indirect taxes also. Then they will have to add other articles of how to allocate the taxing right. So typically it is existing taxes. There is a clause that any future tax which is similar to the current taxes that will also be covered at any point in time that you legislate in the future. So there was a big debate, at the point in time when equalization levy had come in. So a lot of discussion debate was there whether equalization levy is akin to income tax. If it is akin to income tax, it will be covered under the DTA. Therefore, at that point in time, the legislature and levy directly in the Finance Act. Residency provision. How the residency provision domestic tax to you who are let to resend them the slides because the format is not too strict. But that's not possible. It is possible. Give an example. Very simple one. Let's say that so India, US, different financial years that are there. US has calendar year as a financial year. India has. So let's say that I left in 3 days condition. जो आप निकले इंडिया से अप्रैल में in June itself you left India. ROR typically emigrating India is all Indian is always going to remain ROR because of India. So therefore 5 days in previous 4 years very easy to satisfy. To become a clear 25 left India June 2025. What in the US? US is 183 days. So I'm simplifying the situation. US is typically 1/6 of the 2 years before the year of counting, 1/3 of the previous year. Those number of days you have to accumulate and then see whether it crosses 183. Let's say you are staying in US for more than 183 days. June में आप गए, जुलाई से चालू करना, जुलाई, अगस्त, सितंबर, अक्टूबर, नवंबर, दिसंबर. US also you become a resident alien. India also you are a resident and ordinary resident. Now typically this clause says that you have to by reason of either domicile, residence, incorporation, management, any other similar criteria. So by reason of residence under the domestic tax law, I become a resident of India for the purpose of treaty. I also become a resident of then you have to go for the tiebreaker test. Because like residence and source state. Residence is very, very important because resident country can tax your world. They have to give the credit. Other state becomes a source state. So here I am a dual resident. So you have to break the tie in favor of one state. Then that will be the residence Because of entire treaty. You are my resident, but when it comes to the treaty, you may or may not be the resident depending on the tiebreaker test. Have a permanent home in the state in which you claim that you are a resident. Second is side central interest. Where are your economic interests? Where are our social interests? Third is habitual abode. Habitual abode meaning over a long period of time, where have you usually stayed? So if there is a tie at permanent home, so you may have a home in US also, you may have a home in India. So mind you, this is not ownership. Huh? Long-term lease also qualifies as a permanent home. So you may have taken a lease in the US. You would have a home back in India. So the tie does not break. Permanent home at both places. Second, center of vital interest. If you have family back here, versus if you are going there to do business, setting up your economic interests are there, social interests are back home. So again, there's a tie. You cannot break the tie in either because both are equal. Then habitual abode. Habitual abode, then you have to see over a period of time. So initially, the habitual abode will always be in India because you have stayed all your life in India. So then that tie may break. The next is national. You are a national of which state? Passport. वो भी नहीं होता है. Authorities have to break their head and tell you you are a state for the purpose. Business profits establishment. Resident is investing in India. Then under a domestic tax law, there is a concept of business connection. When can their income be taxed? Okay. So these all concepts are there. Agency business connection concept is there. Significant economic presence concept is there. This is under a domestic tax law. If these domestic law residents business income is taxable, that is when you treaty does not constitute business connection. If the non-resident does not have business connection in India, then income and business profits are not taxed. No, go to the treaty. Okay. Under the treaty, what will happen is conduct business reason the income may be taxed in India. Then you go to the treaty to whether the treaty relieves any burden of double taxation or not. Treaty will have a comparable concept of permanent establishment. You cannot import this concept of business connection under the treaty. Treaty will have its own concept. Establishment. Having business connection in India, but do you have a permanent in terms of the don't? The source state cannot tax you. Although under the domestic law, there may be a business connection. Okay. So, yeah. So, as on today, how the treaties, there is no concept of virtue permanent establishment. It is still modeled on the old school of thought only. That is the reason why, that is the reason that pillar 2 is one of the primary reasons for this. That, if you're a online, you are paying at least 15% tax. So no country is being taxed anywhere across the world. So that minimum level of 15% tax is there. So lot of target there. Post taxation by the treaty. So therefore, if you see here, India has legislated significant economic presence. So this is aimed at digital businesses only. where simply the criteria is if you are doing business with a person in India and the turnover is more than 2 CR, you may be selling goods, you may be providing services, whatever. You by default have significant economic presence. Then you go to the treaty to see if it relieves or not. Because treaty in one go cannot be changed entirely. That takes time. Taking measures in order to types of permanent test. The one which the Supreme Court recently. So I'll just give you a brief on proposal. Service fees, provide services other entities in where you are taking a construction in the source state. Agency fees where you have appointed an agent you for earning the income. So you directly are who is an agent who is fully subservient to the foreign to any functions foreign parent country. Though they are legally two different. UN model, it's not there under the OECD model. The source state, then those premiums may be taxed. Okay. Then there is a basic threshold also which is there. Article 5.4 typically, which says that preparatory activities will not constitute P. So then what are those preparatory auxiliary activities? If you are maintaining goods only for display, okay. So let's say Tesla showroom is there. Tesla maybe having one or two models. They will say that Achana, if you want to order, we'll have to import. So if that showroom is only maintained in the country for the purpose of display by itself, then yes. But when you combine that selling goods in that country, because you have this no longer auxiliary activity. See the last line, which case of F, overall activity of business is one of these examples are there. You have to see if you are falling under these exemptions. So if your activity is purely preparatory in nature, auxiliary in nature, liaison office. Okay. Very simple to example, very simple to understand. Foreign entity opens a liaison office in India just for advertising. P income not be taxed, though under FEMA anyway you are not allowed to earn any income. If a unilateral tax credit needs to be given, then at the same time under the treaty, if a tax credit needs to be given, you have to go to rule 128, which lays down the rules. How will you get a tax credit? It is source by source tax credit which is there. So uh, you may be earning different sources of income. So let's take the example of outbound. You may be having investments in UK, you may be having investments in US. From US you are earning interest income, from UK you are earning dividend income. So whatever foreign tax you would have paid in UK versus US, you cannot commingle. What is meant by source by source? Words for each source of income arising from a particular country. This is very important. This is an important slide. Please pay attention to this. What are the different methods of elimination of double taxation? Primarily, there are two. Exemption. Let's say if you are holding, maybe 51% shareholding in the other entity, then whatever dividends that you earn from there, the residence country will not tax. They will be exempted from tax. Okay. So that is the exemption method. Whatever tax you have paid in the source country, we will not tax you again as a resident country. We will exempt that income from tax. That is the exemption method. उसके अंदर भी there are two. One, full exemption. Second is exemption with progression. What do you mean by full exemption? Full exemption with going to tax it. So I think if you see India Poland DTA, if a Polish entity has opened a branch in India, then whatever taxes that the branch will bear in India, Poland will exempt that. As far as I remember, unless it is modified after that. So it is full exemption. What is exemption with progression? Exemption with progression meaning that that income will be at least rates. Okay. So every country may have slab rates. As far as individuals are concerned, for corporates will have slab rates of individual. Okay. UK individual earning income from India. Hypothetically, if India UK provided for exemption method, progression. So what UK will do is exemption on the foreign income will give, but for the purpose of taking into account the slabs, that exempted income, so that you will go into a higher for other incomes that are taxable in UK. So exemption program basically nothing but you aggregate the income for slab rate purposes. What is credit method? Direct credit, indirect credit, special credit. Direct credit is credit. It's as good as India US example, US India UK India US DT 20%. US will have the right to tax on interest. India will direct credit of 20. Is the Indian tax payable maybe 30%. Okay, direct tax. Full उसमें भी दो. Full credit, ordinary credit. Full meaning without conditions. If their tax is higher than our condition is there, they will have to give a refund to you. समझो वहां पे 30% टैक्स पे किया, इंडिया में खाली 20% ही लगता है, in India will have to give you 10% as a refund. That is full credit without conditions. Ordinary credit is typically up to resident state will levy. Okay? So that is one-to-one. Tax paid on the profits of the company, and after dividend, the shareholders will also be taxed on the dividends. So there is economic double taxation. Underlying tax code, what it says is, okay, whatever TDS is there, dividends, wait for that as a resident country. But over that, what I will do is I will even give you the proportionate credit of the corporate tax that entity has paid. Understand this? India Singapore DTA very, very important. So what it says is, if Indian company is earning dividends from a Singapore company may be taxed at over 17%. So 70% corporate tax तो है ही है, वहाँ पे withholding tax रहेगा, समझो for let's assume under the domestic 10%. So 10% credit you will get. उसके अलावा आपको proportionate 17% का corporate tax का भी credit मिलेगा. So that is a underlying tax. Pairing is a concept which is nowadays phased out. So in that, I think India UK, it was possible only for a period of 5 years or so after the treaty was entered. What is tax pairing? India has because of which there is not India say to what is the point? Then the relevance of gone. So what will UK do is have to give a credit assuming 10A exemption was not there. Then only the benefit of 10AA will pass on to the foreign entity. India, UK. I think these two are the last slides which I will do. I may not be able to cover BEPS, MLI, etc. But this is important. Lay down the base, scope provisions that are there, then what is the concept of PE, etc. Now coming to different streams of income. Yeah, Article 6 to 22, which I had referred to. If you see here, substantive provisions. So I have taken the base case of India, UK. Which country has a right to tax which stream of income? Okay. I have simply provided a summary of that in this table. Business profits, resident state will tax. There's a P in the source state. If there's a P in the source state, then it will be taxed in the source. You credit for that. Okay. Dividends. Source state in India, UK, there are two slabs, 10%, 15%, depending on conditions. Maximum 15%. So if UK resident is earning in dividend income from India, India can tax it only maximum up to 15%. Whereas for a resident, if you earn some dividend income from a company, it is as per the slab rates. But for a non-resident earning dividend income from Indian company, it is maximum 15%. Then what will the resident state do? Resident state will give a credit for that. Underlying tax credit is there if it is from the UK side. They are giving underlying tax. This is something. Interest, royalty, FTS. India can tax 15% under the DTA, only up to 15%. So see here, India is foregoing its right to tax. Under the domestic tax law 115A section, 20% tax is there. So 5% right India is foregoing under the India UK DTA. Then UK will tax the FTA's income, but will have to provide a credit for the 15% tax that has been suffered in India. Capital gains in accordance with the domestic tax law of each country, so India can tax it. Independent personal services. What is independent personal services? It is when professionals provide services in an individual capacity in the other state, then you fall under the independent personal services clause. Under the treaty, typically certain conditions are there. If you don't cross state threshold in India, okay, it is 90 days. If you don't have a fixed place to do business, then you are not taxed. If you stay for more than 90 days, done business in India. So UK non-resident individual coming to India on a business visa, staying for 4 months doing business, he will get taxed in India. UK will also tax that, but they will have to give the credit of that. Personal is when trade or second debt, they get taxed. More than 183 days, flat. They will get taxed in India. UK will have to give them the credit provided they still continue as a resident of UK. Directors' fees, athletes, artists. Very important. Coldplay concert in India. Will they get taxed in India or not? For domestic tax law, yes. But if you go to the treaty, yes, taxed in the state of performance. Government pension, private pension, student, teachers, trainees. Student, trainees and teachers typically in the source state, they are not taxed because they are there for a limited period. And then other income. Whatever does not fall under any of the articles goes for it. Okay. Okay, I think I should stop here unless you allow me to continue. Or are we done with the day? Do we have some time? Yeah. You all want to listen more in the presentation or we call it a day? ठीक है चलेगा. Let's do that. So we'll 5-10 मिनट लेते हैं. जो भी queries है please fire them at me. More than happy to answer. जबरदस्त. नहीं ना अभी समझो. Take the example of India UAE outbound situation. If you as an individual is having a fixed deposit in UAE, you are earning interest income. UAE will not tax that. India is only going to tax that. Where is the question of double taxation? Why will even go to the treaty by UAE को taxing right? Domestic law. That is why India will have to give some benefits under the DTA. Na? Then they will come. समझो dividend है. If dividend non-resident percent, को तो 35%. Yes, you are right. Double taxation नहीं है तो भी treaty can come into play because they don't want to suffer tax in India, so they can refer to the DTA and say कि हाँ नहीं, don't levy 35% tax on me, levy direct 15% or whatever reduced rate is there. Correct. In those cases also DTA can come into play. Correct. I stand corrected. Any other question? Yes.
Sir, my question is how much to rely on no P certificate from NR?
It's a very practical question. I'm glad that you asked that. So you have to do your own due diligence. You can't blindly rely on that. So समझो, you know, we have seen in so many cases that client तो बोल देते हैं आपको जो certificate चाहिए we'll give you. But then at the end of the day, you know, we do a global search. उनका देखते हैं अरे website है कि नहीं, India में do they have an address or not? Many a times, you know, we see other address इनका. Question is that ठीक है, you have a place of India, but is this income effectively connected with that? If there is no connection between the India place and the foreign income, yeah, don't blindly rely on no P certificate. So I think that's a given. You have to do your background check. Otherwise, you can be. How do you even certify this?
Thank you.
Yes. Mike,
Sir, if
border की बात
cross in the
exempted.
state of UAE.
Provisions. The scope provisions, you cannot access the DTA itself. You have to be covered under the article person. Okay. Have to be covered. Third, you have to be a resident of either of the state in order to access the DTA. उसके बिना तो आप कर ही नहीं पाओगे. So let's say अभी recent Delhi tribunal decision of in General Motors whether a US LLC can take benefit of the DTA or not. So US LLC में they were examining all these things. Are you a person under DTA? If you are not liable to tax, are you a resident? If you don't satisfy this, the treaty, you can't have access to the treaty. If you can't have access to the treaty, then all these articles that are there are useless for you.
Sir, just one more question in that. For example, if we are UAE, the personal investments are exempt for residents. So from a generic perspective, how to like determine like if there is a non-resident, so whether for a non-resident also the personal income exemption is applicable or not. So if we are doing first time, if we are doing second time, any case on international taxation, so how to like collide all the information, how to collate all the information, and what all things we should keep in mind as a going in international taxation. If like we have to see this DTAA or we have to see this clause or we have to demand such and such documents from the third party so as to evaluate the final effective tax rate.
Okay, I'll give a very simple example. Maybe that's helpful to you. Just like she asked me the question of no P. No P आपका 195 के context में आता है. So let's say you have to give us certificate for lower withholding or no deduction or whatever. What all documents will you want to see? सबसे पहले तो contract देखोगे आप. You will see who is the payee, what is the status of the payee, are they able to satisfy all these conditions or not. Contract you देखोगे to determine what is the income stream that they are earning from India. Have I been able to answer ki nahi?
Yes, I was just thinking about income and all these contracts.
See, sequence मैंने बोला है, you have to bear that in mind. First you have to see under the domestic tax law whether there is any tax or not. This is for an inbound situation. Non-resident investing into India earning income from India, first you have to see domestic tax law में tax है कि नहीं. अगर है then you go to the DTA. अगर है ही नहीं तो there is no point of going to the DTA. So otherwise, so like any other domestic case, now you ask for the documents from the client, understand the fact, try to see what is the tax treatment, case laws देखो, commentary देखो. It's the answer remains the same. It really does not change. International tax है कि domestic tax है. Just don't get intimidated कि अरे international tax है. ऐसा कुछ भी नहीं है. सबसे पहले तो आपको domestic tax देखना है, इसमें non-resident provisions देखना है. Whether there is tax in this or not, then go to the treaty.
Okay, thank you, sir.
Good evening, sir. I have a question related to 15 CACB. If a tenant is an Indian resident and the landlord is NRI, and that tenant is paying the rent in NRO account of the so if that case, you have to find the 15 CACB or
Theoretically, if you ask me, section 195(6), it requires you to file 15 CACB, but nobody does practically.
but as per law, we need to file it.
You need to file that.
So, thank you.
So my question is related to ITR.
ITR.
Huh.
Okay.
Is disclosure in schedule foreign asset required for investment in Indian funds who further invest in foreign companies?
It's not required.
Okay, thank you, sir.
Similar question, है ना? People ask me for gift city also. So GIFT City, if you invest in GIFT City, so resident individuals are allowed to open bank accounts in GIFT City for international investments under LRS. So in that case also, वो schedule F में नहीं आएगा because that's Indian territory. Your investment is in Indian territory only.
Okay, sir. Thank you.
Any more questions? Done? ठीक है, चलो. Thank you very much. Thanks for taking our time. And hope the presentation was good. Just you want to really specialize in this field, I think you guys really have a good fortune कि institute itself has this subject of international tax. In our time तो कोई subject था भी नहीं. So I guess it's an open book exam, right? So you should take that subject. उसके बाद एक diploma course is a good course of institute. You should do that also. उसके आगे करना PAT courses also there which I have done. Advanced Diploma in International Tax is also a good course. And then obviously उसके बाद LLM आते हैं, उसके बाद PhD आते हैं. So lot of things, lot of avenues are there for you to study in depth further in this field if it really, you know, amazes you, fascinates. So for me, it was there right since my articleship days. So I started, you know, concentrating on this right since then. तभी तो institute का कोई course नहीं था, subject was not there. So you should start reading, you know, books, materials, whatever you can lay your hands on. This is a ever evolving field. It's really not going to die. And I'll just give you one analogy. When, you know, I had gone for my LLM, so अभी तो I think 10 साल हो गया. Steps and all LLM करने right time. So web से तो, you know, so many changes have been brought about. Treaty understanding में and, you know, taxation में this that. He told me one very simple thing. This is a ever evolving field. जितने भी changes आएंगे आपका basic same रहेगा. So therefore you can specialize without any end to this. If you really have interest, please follow these steps and, you know, you can really do wonders in this subject. Thank you very much.
Thank you, sir, for such an insightful session. We have surely got to know things which are not just confined in these four walls, may it be Vienna Convention, UN structure, or double taxation. And we are sure that the knowledge that you shared with us has surely left us with double clarity and zero confusion. So with that being said, I would like to call upon our dynamic Vikasa Secretary, Sadav Zariwala, to present official vote of thanks.
Good evening, everyone. So on a scale of 1 to 10, how much did you find today's session valuable and knowledgeable? I need responses. Great. So what a phenomenal start to our 2-day seminar on income tax. Day 1 has truly shown us that taxation is not just about numbers and sections, but it's about compliance, practical knowledge, and the applicability of the same. On behalf of the entire WIRC Vikasa team, it is my absolute honor to deliver this vote of thanks. First and foremost, our heartfelt gratitude to the visionary leaders of WIRC. CA Ketan Sayya, the chairman of WIRC, CA Piyush Chandak, the vice chairman of WIRC, CA Dr. Fenil Shah, the treasurer of WIRC, and CA Jinal Savla, the secretary of WIRC, for their constant support and the contribution in making today's seminar a success. A special word of thanks to our Vikasa Chairman CA Jitendra Saglani and all the regional council members for their constant support to the student community and for their guidance. Now to the star speakers of today, CA Hetal Gada, CA Avinash Rawani, CA Harshal Bhutta, for taking us through the intricacies of tax with such clarity and relevance. Thank you for delivering us this knowledge, and I'm sure this will help us somewhere or the other, be it in our final studies or our articleship application. We also extend our appreciation to the hosts, coordinators, and all the backend team who was there today to support us and to ensure everything ran smoothly. Day 1 has set the tone with knowledge and inspiration. Day 2 awaits us with even more insights. And I'm sure we'll end this seminar with the wealth of knowledge we deserve. Thank you so much for coming and see you all tomorrow. Thank you.